The Secret Meeting, November 22nd, 1910. Cold evening in Hoboken, New Jersey. The private railway station. 7 men board a luxury railroad car. They travel under fake names. They've been instructed to arrive separately, to avoid being seen together. No reporters, no aides, no records of this journey will be kept. These 7 men represent approximately 1/4 of the world's wealth. Among them, the most powerful banker in America, a sitting United States senator, and the architects of the nation's largest financial institutions. They're about to disappear for 9 days. Their destination, a private island off the coast of Georgia, accessible only by boat, owned by some of the richest families in America. What happens on that island will shape the American economy for the next century and beyond. It will create an institution that controls trillions of dollars, influences interest rates, employment, inflation, and nearly every aspect of American economic life. An institution so powerful that its chairman is sometimes called the second most powerful person in America, after the president. Yet for decades, the very existence of this meeting will be denied. The participants will lie about it, refuse to discuss it, take the secret to their graves. When the truth finally emerges, it will fuel conspiracy theories that persist to this day. This is the story of the Jekyll Island meeting, the secret gathering that created the Federal Reserve System. And to understand why it mattered so much, why it had to be secret, and what it means for us today, we need to go back 3 years earlier, to a panic that nearly destroyed the American economy. But first, let's be clear about something. This isn't a conspiracy theory video. We're not going to tell you that the Federal Reserve is run by shadowy cabals or that it's part of some global plot. The real story is more interesting, more complex, and more revealing about how power actually works in America. It's a story about brilliant men solving a genuine problem, but doing it in a way that raises profound questions about democracy, transparency, and who gets to make the decisions that affect us all. The Jekyll Island meeting really happened. The secrecy was real. The participants later admitted it, and the institution they created, whether you think it saved the economy or ruined, it is undeniably one of the most powerful entities in the world. So let's go back to that railway car in November 1910, and follow these 7 men on their secret journey to Jekyll Island. The railway car is luxurious, as befitting men of their station. Plush seats, fine wood paneling, a dining area, sleeping berths, but the atmosphere is tense. These men are taking an enormous risk. If the press discovers this meeting, if word gets out that the nation's most powerful bankers are gathering in secret with a U.S. senator, the political consequences could be devastating. America in 1910 is deeply suspicious of concentrated financial power. The panic of 1907 is still fresh in everyone's memory, a financial crisis so severe that it took J.P. Morgan personally organizing a bailout to prevent total economic collapse. The incident proved 2 things. First, that the American banking system was dangerously fragile. Second, that private bankers had more power over the economy than the government did. Both revelations terrified the public. Progressives demanded reform. Populists raged against the money trust, the handful of banks that controlled the nation's finances. William Jennings Bryan, three-time presidential candidate, thundered against the gold standard and Eastern bankers. The muckraking press exposed the interconnected web of financial power, showing how a small group of men sat on the boards of dozens of corporations and banks, and controlling vast swaths of the American economy. In this climate, for these particular men to meet in secret to design a new banking system is politically explosive. If they're caught, they'll be accused of exactly what many Americans already suspect, that the wealthy elite are conspiring to tighten their grip on the nation's money supply. And here's the thing: that accusation wouldn't be entirely wrong, but it also wouldn't be entirely right. The men on this train genuinely believe the American banking system is broken. They've lived through multiple financial panics. They've seen banks fail, businesses collapse, ordinary people lose their savings. They know that something must change, or the next crisis could be catastrophic. But they also know that any reform they propose will be viewed with suspicion. They're bankers after all. They profit from the existing system. How can they be trusted to redesign it? This is why the secrecy is necessary. They tell themselves. They need time to think, to debate, to craft a plan without public pressure, without political grandstanding, without the newspapers distorting every word. They need to figure out what will actually work, and then only then they'll present it to Congress and the American people. At least, that's the story they tell themselves. Whether you believe it depends on what you think about democracy, expertise, and who should make the decisions that shape our economic lives. As the train rolls south through the darkness, these 7 men are about to spend 9 days creating the blueprint for the Federal Reserve System, a system that in various forms controls the American economy to this day, a system that has prevented some crises and exacerbated others, a system that has been praised as America's great economic stabilizer and damned as an unconstitutional seizure of monetary power by private banks. But before we get to those 9 days on Jekyll Island, we need to understand the crisis that made this meeting necessary. We need to go back to 1907, a panic that shook America to its core and revealed just how fragile the entire financial system really was. The banking crisis of 1907, October 1907, New York City. The American economy is booming. Stock prices are climbing. New businesses are launching daily. Credit is easy. Money is flowing. Everyone is making money. And then, suddenly it all stops. Starts with a failed attempt to corner the copper market. To speculators, F. Augustus Hines and Charles W. Morse try to manipulate the price of United Copper Company stock. They borrow heavily to buy up shares, planning to squeeze short sellers and make a fortune. But the scheme collapses. The price crashes. Heinz and Morse are ruined. So what? Speculators fail all the time. Why does this matter? Because Heinz and Morse own banks, multiple banks. And when their scheme fails, depositors panic. If the owners of these banks just lost everything, what about the deposits? Are the banks solvent? And people get their money out? The panic spreads, first to banks associated with Heinz and Morse, then to banks that do business with those banks, then to banks that are simply rumored to be in trouble. And in 1907, once a panic starts, there's no mechanism to stop it. Here's how banking worked in 1907 and why it was so vulnerable to panic. Most banks operated on what's called fractional reserve banking. This means they don't keep all their depositors' money in the vault. They keep a fraction, maybe 10 or 20%, and lend out the rest. This is actually how banks make money. You deposit $100, they keep 20 in reserve, and lend out 80 to someone who needs a loan. That borrower pays interest, and that's the bank's profit. This works fine as long as depositors don't all want their money at once. But if they do, if there's a run on the bank can't pay everyone, not because the bank is necessarily insolvent, but because most of the money is out in loans that can't be called in immediately. In 1907, there's no Federal Deposit Insurance Corporation, no FDIC insurance protecting your deposits, no central bank to provide emergency loans to troubled banks, no government safety net at all. So when rumors start that a bank might be in trouble, depositors rush to withdraw their money. And because everyone is trying to withdraw at once, the bank runs out of cash. This proves to everyone else that the bank is in trouble, so they rush to withdraw too. The panic becomes self-fulfilling. By late October 1907, the panic is spreading across New York. The Knickerbocker Trust Company, one of the largest trusts in New York, faces a devastating run. On October 22nd, depositors line up outside the bank, desperate to get their money. The Knickerbocker pays out $8 million in 3 hours. Then it runs out of cash and closes its doors, unable to honor any more withdrawals. The next day, panic spreads to other trusts and banks. Lines of desperate depositors stretch around city blocks. Some banks pay out as much as they can and then suspend operations. Others never open their doors at all. The stock market crashes. Stock prices plummet. Businesses can't get credit. Payrolls can't be met. Companies start laying off workers. The panic spreads beyond New York to cities across the country. By the end of October, the American financial system is on the brink of total collapse. This is when J.P. Morgan steps in. John Pierpont Morgan is 70 years old in 1907, and he's the most powerful private banker in the world. Not the richest, there are men with more money, but no one has more power, more connections, more ability to move money and influence markets. Morgan sees that the panic will destroy the entire financial system unless someone acts. And the only someone with the power to act is him. He essentially locks the most important bankers in New York into his library, literally locks the doors, and forces them to pool their resources to support failing institutions. He organizes a $50 million loan to keep the New York Stock Exchange from collapsing. He persuades John D. Rockefeller to deposit tens of millions in struggling banks to shore up confidence. He coordinates with the U.S. Treasury to inject government funds into the system. It works. Barely. By mid-November, the panic is subsiding. Banks reopen. The stock market stabilizes. The economy doesn't collapse, but the cost is enormous. Hundreds of banks and businesses fail. Thousands lose their savings. Unemployment spikes. The economy slides into recession. And Americans are left with the terrifying realization their entire economic system had been saved only by the intervention of one private citizen. One man acting on his own authority had prevented financial catastrophe. This is both reassuring and horrifying. Reassuring because Morgan had saved the day. Horrifying because it revealed how fragile the system was and how much power was concentrated in private hands. What if Morgan had been out of the country? What if he'd been too sick to act? What if he'd had a conflict of interest or made different decisions? The panic of 1907 makes clear to everyone from Wall Street bankers to populist politicians that something has to change. America needs a more stable banking system. Some kind of mechanism to prevent or contain financial panics. Some institution that can provide liquidity in a crisis, support solvent but illiquid banks, and restore confidence when panic threatens. In other words, America needs something like a central bank. But there's a problem. Americans hate central banks. The United States had two central banks in its early history, and both were controversial and ultimately abolished. The first Bank of the United States, chartered in 1791, lasted only 20 years before Congress refused to renew its charter. The Second Bank of the United States, chartered in 1816, was even more controversial. President Andrew Jackson made destroying it a central goal of his presidency, calling it a corrupt monopoly of the rich against the poor. He vetoed the renewal of its charter in 1832, and the bank died in 1836. Since then, for more than 70 years, America has operated without a central bank, and many Americans, especially in the South and West, believe this is how it should be. Central banks, they argue, give too much power to Eastern bankers. They manipulate currency for the benefit of the wealthy. They're tools of the money trust to control the economy and exploit ordinary people. So in the aftermath of the Panic of 1907, there's widespread agreement that banking reform is needed, but no agreement on what that reform should look like, and deep suspicion of anyone who proposes solutions. This is the challenge facing the men who will board that train to Jekyll Island in November 1910. They need to design a system that will stabilize American banking and prevent future panics, but they need to do it in a way that won't look like like they're creating a central bank controlled by Wall Street, and they need to do it in secret, because if the public knows they're the ones designing it, the plan will be dead on arrival. To understand who these men are and why they're the ones taking on this challenge, we need to look at each of them individually. 7 men representing different interests and different perspectives, but united in believing that they can solve this problem. Let's meet the architects of the Federal Reserve, the key players, power brokers of 1910. Nelson Aldrich. He's the reason this meeting is happening, and in many ways, he's the reason it has to be secret. Aldrich is a United States Senator from Rhode Island, and in 1910, he's one of the most powerful men in Washington. He's been in the Senate for 30 years. He chairs the Senate Finance Committee, which gives him enormous influence over banking and currency legislation. He's the Republican Party's expert on economic policy, and he's rich, very rich, having made a fortune through strategic investments in banking, utilities, and other industries. He's also deeply connected to the very financial interests he's supposed to be regulating. His daughter married John D. Rockefeller Jr., making him related by marriage to America's richest family. He sits on corporate boards. He has extensive business relationships with the major banks. Critics call him the senator from Wall Street, or the general manager of the nation, suggesting he's more loyal to big business than to the public interest. This makes him the perfect person to lead banking reform. He has the power, the expertise, and the connections to get legislation through Congress. But it also makes him the worst person. Any plan associated with Aldrich will be attacked as a scheme to benefit Wall Street at the expense of ordinary Americans. Aldrich knows this. After the Panic of 1907, he was appointed head of the National Monetary Commission, a congressional body tasked with studying banking systems and recommending reforms. He spent 3 years traveling to Europe, studying how central banks work in other countries and consulting with experts. He's genuinely trying to solve the problem, but he also knows that whatever plan he proposes will be viewed through the lens of who he is, a wealthy, conservative Republican with deep ties to the banking industry. So he needs a plan that's technically sound, politically feasible, and can somehow overcome the suspicion that will automatically attach to anything bearing his name. This is why the Jekyll Island meeting must be secret. People know that Aldrich is meeting with top bankers to design a new banking system. They'll assume the worst. But if he can present a plan that seems to come from an objective study by the National Monetary Commission, it might have a chance. At least that's the theory. The second man on our list is A. Piatt Andrew. He's the least famous of the Jekyll Island 7, but in some ways, the most important. Andrew is an economics professor at Harvard. He's 36 years old in 1910, the youngest man on the trip. He's brilliant, with expertise in monetary theory and banking history, and crucially, he's the Assistant Secretary of the Treasury, which gives him both government credibility and technical knowledge. Andrew serves as the Secretary of the National Monetary Commission under Aldrich. This means he's done much of the actual research and preparation for banking reform. He studied the European central banks. He understands the technical details of how different monetary systems work. He can explain the economic theory behind various proposals. Andrew is on this trip to provide expertise and to document the discussions. He takes notes, asks questions, and helps translate between the theoretical proposals and practical implementation. He's the academic voice in a room full of bankers and politicians, but he's also deeply embedded in the existing financial system. His academic work has been funded by banking interests. His government position gives him insider knowledge that could benefit private banks. He's walking a fine line between being an objective expert and being a tool of the industry he's supposed to be studying. Still, his presence gives the Jekyll Island meeting some intellectual credibility. This isn't just bankers dividing up the spoils. There's a serious economist involved, someone who's studied these issues carefully and understands the theory behind what they're trying to create. The third participant is Frank Vanderlip. He's the president of National City Bank of New York at the time, the largest bank in America. Vanderlip represents the banking industry's perspective, but he's not a typical banker. He started as a financial journalist, which gave him a different view of the banking system than someone who'd spent their career in banking. He understands how the press works, how public opinion forms, and how to communicate complex financial ideas to a general audience. This makes him valuable at Jekyll Island for 2 reasons. First, he understands the technical details of banking. He's run the largest bank in America, so he knows what bankers need and how the system actually functions. Second, he understands public relations. He knows how any proposed reform will be received by the press and the public, and how to frame it to minimize opposition. Vanderlip is also deeply ambitious. He wants National City Bank to be the dominant financial institution in America, and he sees banking reform as an opportunity to strengthen the system while also positioning his bank advantageously. He's not just there to solve a public problem, he's there to protect and advance his business interests. Later in life, Vanderlip will write about the Jekyll Island meeting, and his account will be one of the main sources of information about what happened there. But he'll wait decades to publish, respecting the secrecy that all participants agreed to maintain. Henry P. Avison's next a partner at J.P. Morgan & Company, and in many ways J.P. Morgan's personal representative at this meeting. Avison is 53 years old in 1910, a seasoned banker who's been at the center of American finance for decades. He was intimately involved in Morgan's rescue of the financial system during the 1907 panic. He knows firsthand how fragile the banking system is and how close it came to total collapse. Morgan himself doesn't attend the Jekyll Island meeting. He's too prominent, too powerful, too much of a lightning rod. J.P. Morgan is seen boarding a train with Senator Aldrich. Every newspaper in America will scream about the money trust conspiring against the people. So Morgan sends Davison as his representative, with instructions to ensure that any banking reform protects Morgan interests while also stabilizing the system. Davison brings a practical banker's perspective to the discussions. He's not interested in theoretical debates or political considerations. He wants to know, will this system work? Will it prevent another panic? Will it allow banks to function more efficiently? Will it provide liquidity when needed? He's also acutely aware that any new banking system will shift power and advantage between different financial institutions. He's there to make sure that J.P. Morgan and Company isn't disadvantaged by whatever system emerges. Charles D. Norton represents yet another perspective. He's president of the First National Bank of New York, which makes him one of Vanderlip's competitors. But he's on this trip because Aldrich wants multiple banking perspectives, not just one bank's agenda. Norton is practical and conservative. He's skeptical of radical reforms. He wants banking reform to be gradual, careful, and protective of existing institutions. He's worried that too much change too quickly could destabilize the system rather than strengthen it. He's also the most politically astute of the bankers. He understands that any banking reform will face fierce opposition from populists, progressives, and anyone suspicious of Wall Street. He pushes the group to think about political feasibility, not just technical soundness. Later, Norton will serve as Assistant Secretary of the Treasury under President Taft, which gives him even more influence over the implementation of banking reform. But in 1910, he's primarily there to represent the perspective of major New York banks and to ensure that their interests are protected in whatever plan emerges. Now we come to Paul Warburg, and in many ways, he's the most important person on this trip. Warburg is a German immigrant and a partner at Kuhn, Loeb and Company, one of New York's most powerful investment banks. He's 42 years old in 1910, and he's been in America for only 8 years. But in that short time, he's become the nation's most prominent advocate for banking reform. Warburg grew up in the German banking system, which has a strong central bank, the Reichsbank. He's seen how a central bank can stabilize an economy, provide liquidity during crises, and coordinate monetary policy. And he's appalled by the American banking system, which he views as primitive, chaotic, and dangerous. Since arriving in America, Warburg has been on a crusade to create a central bank. He's written articles, given speeches, and lobbied politicians. He's become the intellectual architect of the movement for banking reform, and he's developed a specific vision for what an American central bank should look like based on European models, but adapted to American conditions and American political sensibilities. The problem is that Warburg is foreign, Jewish, and works for an investment bank. In 1910 America, all three of these facts make him suspect to large portions of the public. Anti-immigrant sentiment is strong. Anti-Semitism is casual and widespread. And investment banks are viewed as parasitic institutions that manipulate money without producing anything of value. So while Warburg may have the best ideas about banking reform, he's also politically toxic. Any plan that's seen as Warburg's plan will face immediate opposition from xenophobes, anti-Semites, and populists who distrust Wall Street. This is another reason for the Jekyll Island secrecy. Warburg can present his ideas, date the plan, and provide technical expertise, but his role must remain hidden. The plan must appear to come from Aldrich's National Monetary Commission, not from a German immigrant banker. Warburg will spend 9 days at Jekyll Island essentially teaching a masterclass on central banking to the other participants. He'll explain how European central banks work. He'll outline the principles that should guide American reform. He'll draft much of the actual plan, but when it's presented to Congress, his name will be nowhere on it. Later in life, Warburg will become the vice chairman of the Federal Reserve Board, essentially the second most powerful position in the Federal Reserve System. But even then, his foreign birth and banking background will make him controversial, and he'll eventually resign under pressure. The final participant is Benjamin Strong, and while he's the least senior of the group in 1910, he'll ultimately become the most important. Strong is 37 years old, and he's a vice president at Bankers Trust Company in New York. He's not as prominent as Vanderlip or Davison, not as powerful as Aldrich, not as theoretically sophisticated as Warburg, but he's brilliant, hardworking, and deeply trusted by J.P. Morgan personally. Strong played a crucial role in Morgan's rescue operations during the 1907 panic. He worked around the clock organizing loans, coordinating between banks, and helping to prevent total collapse. Morgan was impressed, and Strong became one of his most trusted lieutenants in financial matters. Strong is on the Jekyll Island trip partly as Davison's assistant, partly as Morgan's eyes and ears, and partly because the group recognizes that he'll likely play an important role in implementing whatever system they design. And they're right. When the Federal Reserve System is finally created in 1913, Strong will become the first governor of the Federal Reserve Bank of New York, the most powerful of the regional reserve banks. He'll essentially run the Federal Reserve System for 14 years, until his death in 1928. More than any other single person, Strong will shape how the Federal Reserve actually functions in its early decades. But in November 1910, he's just the junior man on a secret mission to redesign American banking. These are the 7 men boarding that train in Hoboken. They represent immense wealth, enormous power, and extraordinary expertise. They also represent a fundamental tension in American democracy. Is it appropriate for such a small group of unelected men, all from the financial industry, to design the nation's banking system in secret. Defenders of the Jekyll Island meeting argue that complex technical problems require expertise, and expertise often resides in the industries being regulated. These men understood banking better than anyone else in America. They'd lived through financial panics, run major institutions, studied monetary systems around the world. Who better to design banking reform? Critics counter that this is exactly the problem. These men had enormous conflicts of interest. They profited from the existing system and would profit from any new system. Allowing them to design banking reform is like letting foxes design the henhouse. No matter how expert they are, their interests are not aligned with the public good. Both perspectives have merit, and this tension between expertise and democracy, between efficiency and transparency, between technical competence and democratic legitimacy runs through the entire Jekyll Island story. As the train rolls south through the night, these 7 men are carrying the weight of these contradictions. They believe they're doing the right thing, solving a real problem, creating a system that will benefit the nation. But they also know that if their role in creating this system becomes known too soon, political opposition will kill it. So they travel in secret, using fake names, to a private island where they'll spend 9 days designing the blueprint for the Federal Reserve System. Let's follow them to Jekyll Island and see what happens next. The journey to Jekyll Island. The train ride from New Jersey to Georgia takes about 24 hours in 1910. The men spend it reviewing documents, discussing banking systems, and maintaining their cover story. They've been told to use only first names when talking to each other, to avoid being overheard and identified. Senator Aldrich is Nelson. The others follow suit. If any railroad employees or other passengers ask who they are, they're a group of businessmen going on a hunting trip. It's a thin cover story, but it works. The railroad car is private, limiting their interactions with others. And in 1910, there are no photographers lurking at every stop, no social media to broadcast their movements, no 24-hour news cycle demanding to know where prominent figures are every moment. Still, the men are nervous. If even one reporter figures out what's happening, if even one newspaper runs a story about Senator Aldrich traveling with top Wall Street bankers, the political consequences could be devastating. The meeting would be portrayed as a conspiracy of the money trust. Any banking reform proposal would be dead before it started. They arrive in Georgia and transfer to a boat for the final leg to Jekyll Island. The island is about 7 miles long and 1 mile wide, off the coast of Georgia near Brunswick. It's owned by the Jekyll Island Club, an ultra-exclusive organization whose members include some of the wealthiest families in America: Morgans, Vanderbilts, Rockefellers, Pulitzers. In 1910, Jekyll Island is essentially a private resort for the super rich. Membership in the Jekyll Island Club is limited and expensive. The club owns the entire island, and members bill cottages, though that's a laughable understatement for the massive houses these families construct. The island has its own power plant, water system, and staff to serve the wealthy families who winter there. By November, the main social season is over. Most of the wealthy families have left. The island is largely empty, making it perfect for a secret meeting. The club assigns the men comfortable accommodations in the clubhouse, provides servants and chefs, and ensures their privacy. The location is ideal for another reason: it's isolated. No one can stumble upon their meeting. No reporters can lurk outside taking notes. No curious politicians can drop by to observe. The men can work without interruption, without observation, without the pressure of public scrutiny. They settle in and get to work. For the next 9 days, they'll meet for long hours, debate fiercely, and ultimately produce a plan that will reshape American banking. But first, they have to agree on what problem they're actually trying to solve. 9 days that changed America. Day 1. The 7 men gather in the clubhouse. Warburg has brought a stack of documents, analyses of European central banks, proposals for American reforms, economic data. Aldrich has the National Monetary Commission's research. The others bring their practical experience and their bank's interests. The first order of business is defining the problem. What exactly is wrong with the American banking system? What are they trying to fix? Everyone agrees on the basics. The American banking system is fragmented and unstable. There are thousands of banks, but no coordination between them. No institution that can provide liquidity during a crisis. No way to expand or contract the money supply in response to economic conditions. No mechanism to prevent or contain financial panics. The Panic of 1907 proved all of this. Without J.P. Morgan's personal intervention, the entire system would have collapsed. That's not a sustainable way to run an economy. What if Morgan hadn't been available? What if the next crisis is bigger than one man can handle? So the first goal is clear: create some kind of institution that can provide stability and prevent panics. But the question is, what kind of institution? This is where the debates begin, and they're fierce. These men may be united in wanting reform, but they have very different ideas about what that reform should look like. Warburg argues for a strong central bank, modeled on the European systems he knows. A single institution with the power to set monetary policy, provide emergency loans to banks, and coordinate the banking system. It should be powerful enough to act decisively in a crisis, insulated from political pressure, and run by banking experts who understand the technical complexities of monetary policy. This makes sense from a technical standpoint. Strong central banks in Europe have prevented the kind of panics that plague America. The Bank of England, the Reichsbank in Germany, the Banque de France all have proven that centralized monetary authority can stabilize an economy, but the other men immediately see the political problem. Americans hate central banks. They killed 2 central banks already. Any proposal that looks like a European-style central bank will be destroyed in Congress. Populists will scream about the money trust seizing control of the nation's currency. Southern and Western politicians will rage about giving even more power to New York banks. So how do you create a central bank without calling it a central bank? How do you centralize monetary authority while making it look decentralized? This becomes the central challenge of the Jekyll Island meeting. The men need to design a system that has the functional power of a central bank, the ability to create currency, provide liquidity, and coordinate monetary policy, but doesn't look like a central bank to suspicious politicians and voters. They debate structure. Should there be one institution or many? If many, how should they be organized? How should power be distributed? They debate governance. Who should control the system? Bankers, government appointees, some combination. How do you ensure expertise while maintaining democratic accountability? They debate the money supply. Should the system create elastic currency money that expands and contracts with economic needs? How do you prevent inflation while ensuring enough currency for economic growth? They debate private versus public. Should this be a government institution or a private one? Who should own it? Who should profit from it? The days blur together. They work morning until night, breaking only 4 meals. They argue, compromise, revise. Warburg does much of the drafting, explaining technical concepts and translating European models into American terms. Aldrich thinks about political feasibility. The bankers advocate for their institution's interests. Andrew takes notes and asks questions that force them to clarify their thinking. Gradually, a plan emerges. It's a compromise between Warburg's vision of a strong central bank and the political reality that such a bank would never pass Congress. Here's what they decide. First, the structure. Instead of one central bank, there will be regional reserve banks, maybe 10 or 12, spread across the country. This makes it look decentralized. No single institution in New York controlling everything. And this is crucial, these regional banks will be coordinated by a central board in Washington. So it's functionally centralized while appearing decentralized. Second, the governance. The regional reserve banks will be owned by private banks. The member banks in each region will hold stock in the reserve bank. This makes it look like a private system, not a government takeover of banking. But the central board in Washington will have government appointees. So it's a hybrid private ownership with government oversight. Third, the currency. The system will issue Federal Reserve notes, a new form of currency backed by commercial paper and gold. This currency will be elastic. It can expand when the economy needs more money and contract when there's too much. This solves the problem of periodic currency shortages that had contributed to past panics. Fourth, the lender of last resort. The reserve banks can provide emergency loans to member banks in trouble, preventing runs and panics. This is what Morgan did personally in 1907, but now it's institutionalized. Fifth, check clearing. The system will make it easier for checks to clear between banks in different regions, improving the efficiency of the banking system. The plan is clever. It creates the functional equivalent of a European central bank while packaging it in a way that might be politically palatable to Americans. It's decentralized in appearance but centralized in function. It's privately owned but government supervised. It looks like many regional banks but functions as one coordinated system. Warburg isn't entirely happy. He thinks it's too decentralized, too political, too compromised, but he recognizes that it's the best they can achieve given American political realities. The bankers aren't entirely happy either. They would prefer even more private control and less government oversight, but they recognize that some government role is necessary for political legitimacy. Aldrich is satisfied. He thinks this plan can pass Congress. It's technically sound, politically feasible, and addresses the real problems in the banking system. By the end of 9 days, they have a draft plan. It's about 30 pages, outlining the structure, governance, and functions of what will be called the National Reserve Association. They call it the National Reserve Association rather than a central bank, because central bank is political poison, but functionally, that's what it is. The men return to New York on different trains, maintaining the secrecy. They've been gone for 9 days, and no one knows where they've been or what they've been doing. Now comes the hard part. Selling this plan to Congress and the American people without revealing who designed it or where it was created. The Aldrich Plan, selling centralized banking. January 1911. Nelson Aldrich presents the banking reform plan to the National Monetary Commission. He frames it as the result of years of study, consultation with experts, and analysis of banking systems around the world. He doesn't mention Jekyll Island. He doesn't mention the top Wall Street bankers secretly drafted the plan. He doesn't mention Paul Warburg's central role in designing it. The plan is officially called the Aldrich Plan, after the senator presenting it. This is both good and bad. Good because Aldrich's name carries weight in Congress and in financial circles. Bad because Aldrich is so closely associated with Wall Street that anything bearing his name will be automatically suspect to progressives and populists. The National Monetary Commission formally endorses the plan in January 1911. Aldrich begins his campaign to build support. He gives speeches, he writes articles, he meets with business leaders, bankers, and politicians. He argues that the plan will prevent future financial panics, stabilize the banking system, and make American business businesses more competitive internationally. The response is mixed at best. Bankers generally support it, though somewhat more private control and less government oversight. They like the idea of a lender of last resort, an institution that can provide emergency loans during crises. They appreciate the more efficient check clearing system. They want the ability to create elastic currency that responds to business needs, but they're also suspicious. Some fear that too much centralization will give New York banks even more power over regional banks. Others worry that government oversight will lead to political interference in banking decisions. And some simply don't trust that Congress will implement the plan as designed. They fear it will be amended and distorted until it no longer serves banking interests. Business leaders are also divided. Large corporations that depend on stable credit support the plan, but smaller businesses worry it will make them even more dependent on big banks. Importers and exporters like the international coordination aspects, but domestic manufacturers fear it will benefit international trade at their expense. The political response is harsh and immediate. Progressive Republicans like Robert La Follette of Wisconsin attack the plan as a scheme to give Wall Street even more power. They point out correctly that it was designed by bankers and will be controlled by bankers. They argue that it will create a money monopoly that will exploit farmers, workers, and small businesses. Democrats are even more hostile. William Jennings Bryan, still influential despite losing 3 presidential campaigns, announces the plan as the money trust's plan to control the nation's currency. He argues that any banking reform must be government-controlled, not banker-controlled. Southern Democrats, representing agricultural regions that have long felt exploited by Eastern banks, are particularly vehement in their opposition. They see the Aldrich plan as another attempt by New York banks to tighten their grip on the economy. Western populists pile on. They're suspicious of any banking reform that comes from Wall Street. They want inflation, not stable currency. Inflation helps debtors and hurts creditors, so it favors farmers with mortgages over banks holding the mortgages. The Aldrich plan's goal of stable currency works against their interests. Socialists attack from the left, arguing that banking should be entirely nationalized and run by the government for public benefit, not private profit. The press is skeptical. Muckraking journalists have spent years exposing the interconnected web of banking power, the money trust that controls credit, manipulates markets, and dominates the economy. The Aldrich plan looks like exactly what they've been warning about. Bankers creating a legal framework to institutionalize their power. By mid-1911, it's clear the Aldrich plan is in trouble. It has support among bankers and some business leaders, but it faces fierce opposition from progressives, populists, Democrats, and anyone suspicious of concentrated financial power. Aldrich pushes forward anyway. He's convinced the plan is technically sound and economically necessary. He believes that if he can explain it properly, overcome the misconceptions, and demonstrate its benefits, opposition will fade. He's wrong. The problem isn't that people don't understand the plan. The problem is that they don't trust who created it. As long as the plan is associated with Aldrich and Wall Street bankers, it will face insurmountable political opposition. What the plan needs is a champion who isn't a Wall Street Republican, someone who can present banking reform as populist, progressive, and democratic, someone who can separate the technical merits of the plan from the political toxicity of its origins. That champion emerges in 1912, but not in the way Aldrich expected. From Aldrich to Federal Reserve, the election of 1912 changes everything. The Republican Party splits. President William Howard Taft runs for re-election as the regular Republican candidate, but Theodore Roosevelt, angry at Taft's conservatism, bolts from the party and runs as a progressive, the Bull Moose candidate. The Republican vote splits between Taft and Roosevelt. This opens the door for the Democrats. They nominate Woodrow Wilson, the reform-minded governor of New Jersey and former president of Princeton University. Wilson runs on a progressive platform, promising to break up monopolies, reform banking, and make the economy work for ordinary people rather than the wealthy elite. Wilson wins in a landslide. The Democrats also take control of both houses of Congress. Suddenly, the political landscape has completely changed. The Republicans who supported the Aldrich plan are out of power. The Democrats who opposed it are in charge. The Aldrich plan is dead. Everyone knows it. Anything associated with Aldrich and Wall Street Republicans won't pass a Democratic Congress or be signed by a progressive Democratic president. But the need for banking reform hasn't disappeared. Problems that the Aldrich plan tried to solve are still there. The banking system is still fragile. Financial panics are still a threat. Something still needs to be done. This is where it gets interesting, because while the Aldrich plan is politically dead, the ideas behind it are very much alive. Woodrow Wilson appoints Carter Glass as chairman of the House Banking Committee. Glass is a Democratic congressman from Virginia, a fierce opponent of the money trust, and a supporter of banking reform, but only if it's controlled by the government, not by private bankers. Glass hires H. Parker Willis, an economics professor, to help him design a banking reform plan. Willis studies the Aldrich plan carefully, and he realizes something interesting. The basic structure is sound. The idea of regional reserve banks coordinated by a central board, the elastic currency, the lender of last resort function, the check clearing system. These are good ideas regardless of who came up with them. The problem isn't the technical design. The problem is the governance. The Aldrich plan gave too much control to private bankers and not enough to the government. If you flip that, keep the structure, but change who's in control, you might have a plan that Democrats can Republican support. So Glass and Willis essentially take the Jekyll Island blueprint and modify it. They keep the regional structure. They keep the elastic currency. They keep the lender of last resort function. But they change the governance. In the Aldrich Plan, bankers dominated the system with limited government oversight. In the Glass Plan, government appointees control the central board, with bankers having influence but not control. It's still a hybrid public-private system, but the balance of power shifts toward public control. Wilson likes this approach. It addresses the banking instability problem while also checking the power of the money trust. It's reform without surrendering government authority to private bankers. But there's pushback from multiple directions. Some Democrats, especially William Jennings Bryan and his populist supporters, think the plan doesn't go far enough. They want complete government control of banking, with no private ownership at all. They want the currency to be issued directly by the government, not by private banks through the reserve system. Progressive Republicans, meanwhile, are suspicious that the plan is just the Aldrich Plan in disguise, same structure, different label. They worry that despite government control on paper, bankers will still dominate in practice. Conservative bankers, ironically, also oppose the plan. They prefer the Aldrich Plan's greater private control. They fear that government control will lead to political interference, inflationary policies, and instability. Wilson has to navigate between these factions. He needs enough progressive support to pass the bill, but he can't alienate moderate Republicans and Democrats. He needs some banker support to ensure the system will actually work, but he can't appear to be serving Wall Street interests. The negotiations are intense and complex. Bryan demands that the Federal Reserve currency be government obligations, not bank notes. Wilson agrees to this change. Federal Reserve notes will be obligations of the United States government, not private institutions. This is a significant concession to populist concerns. Progressive Democrats demand that the Federal Reserve Board be entirely composed of government appointees, with no banker representation. Wilson agrees to this too. The board will have no bankers, only presidential appointees and ex officio government officials. Regional bankers demand that there be enough reserve banks, at least 12, to ensure that New York doesn't dominate. Wilson accepts this, creating 12 regional Federal Reserve banks instead of the Aldrich Plan's smaller number. Agricultural interests demand that the system be able to provide credit to farmers, not just to commercial banks. Wilson adds provisions for agricultural lending. Small banks demand that membership be optional, not mandatory. Wilson makes national banks required to join, but allows state banks to choose. Throughout 1913, the legislation evolves through dozens of revisions. Last shepherds it through the House. Robert Owen, chairman of the Senate Banking Committee, guides it through the Senate. Wilson uses all his political capital to push it forward. The debates are fierce. Opponents on the left say it gives too much power to bankers. Opponents on the right say it gives too much power to government. Conspiracy theorists claim it's a plot by international bankers to control America. Populists claim it will lead to inflation and currency manipulation. But slowly support builds. Progressive Democrats are reassured by the government control. Moderate Republicans recognize the need for banking reform. Enough senators and representatives conclude that while the plan isn't perfect, it's better than the chaotic system they have. On December 23, 1913, Congress passes the Federal Reserve Act. Wilson signs it the same day. After years of debate, after the secret Jekyll Island meeting, after the failure of the Aldrich Plan, banking reform finally becomes law. The Federal Reserve System is born. But is it the system that was designed at Jekyll Island? Yes and no. The structure is essentially the same. Regional reserve banks coordinated by a central board in Washington. The functions are the same: elastic currency, lender of last resort, check clearing, monetary policy coordination. But the governance is different. With the Jekyll Island Plan emphasized private banker control with government oversight. The Federal Reserve Act emphasizes government control with private banker participation. The Federal Reserve Board is entirely composed of government appointees. The President selects them, the Senate confirms them, and they serve fixed terms to ensure independence from both political pressure and banking industry pressure. The regional Federal Reserve banks are still owned by member banks. That part stays from the Jekyll Island Plan, but they're supervised by the government-controlled Federal Reserve Board in Washington. To compromise between the Jekyll Island vision of a banker-controlled system and the populist vision of a government-controlled system. Either side gets exactly what they want, but both get enough to make the system workable. Paul Warburg, the architect of the Jekyll Island Plan, is appointed to the Federal Reserve Board. He serves as vice chairman from 1914 to 1918, helping to implement the system he'd spent years advocating for. But he faces constant criticism for his foreign birth and banking background, and he eventually resigns under pressure. Benjamin Strong becomes the governor of the Federal Reserve Bank of New York in 1914 and serves until his death in 1928. He essentially runs the Federal Reserve System during its crucial early years, making New York the dominant reserve bank despite the supposedly equal regional structure. Nelson Aldrich never gets credit for his role in creating the Federal Reserve. The system that emerges bears his fingerprints. It's based on the plan drafted at Jekyll Island, but it carries Carter Glass's name and Woodrow Wilson's signature. Aldrich retires from the Senate in 19 1911, before the Federal Reserve is created. He dies in 1915, living just long enough to see a transformed version of his plan become law. The other Jekyll Island participants return to their banking careers. Most of them prosper under the new system. Their banks become more stable, their businesses more secure. Whether that's because the Federal Reserve actually improves the banking system or because the people who designed it ensured it would benefit their institutions is a question that still generates debate. For decades, the Jekyll Island meeting remains secret. The participants honor their agreement not to discuss it publicly. Occasional rumors surface, whispers about a secret meeting, speculation about who really designed the Federal Reserve, but nothing concrete. It's not until the 1930s that the full story emerges. Frank Vanderlip publishes an account of the Jekyll Island meeting in his memoirs. B.C. Forbes, a financial journalist and father of Malcolm Forbes, who founded Forbes magazine, publishes an article describing the meeting in detail. Other participants, now elderly or deceased, are finally identified. When the secret becomes public, it fuels exactly the kind of conspiracy theories that Aldrich feared. They had to meet in secret. People reason they must have been doing something wrong. If they had to hide their role in creating the Federal Reserve, it must be because the Federal Reserve is a conspiracy against the public interest. These conspiracy theories persist to this day, growing more elaborate and divorced from reality with each retelling. But beneath the conspiracy nonsense, there's a legitimate question. Was the Jekyll Island meeting appropriate? Should 7 unelected men, all from the banking industry, have secretly designed the nation's central banking system? Before we can answer that question, we need to understand what the conspiracy theories get wrong, what they get right, and why the Jekyll Island meeting still matters more than a century later. The conspiracy theories vs. reality. Let's start with what the conspiracy theories get wrong, because there's a lot of misinformation about Jekyll Island and the Federal Reserve. Conspiracy theorists claim that the Federal Reserve is a private corporation owned by international bankers who use it to control the world economy, manipulate governments, and extract wealth from ordinary people. They claim it's unconstitutional, that it operates in secret, that it's never been audited, that it's controlled by the Rothschilds or other shadowy financial dynasties. Almost all of this is false. Federal Reserve is not a private corporation in the normal sense. It's a unique hybrid institution. 12 regional Federal Reserve banks are technically owned by their member banks, but they can't be sold, can't be transferred, and don't operate like private businesses. They're more like cooperative institutions with government oversight and control. Federal Reserve Board, the governing body that sets policy, is entirely composed of government appointees. They're selected by the President and confirmed by the Senate. They serve fixed terms to ensure independence, but they're government officials, not private bankers. The Federal Reserve is not unconstitutional. The Constitution gives Congress the power to coin money and regulate the value thereof. Congress created the Federal Reserve through legislation, delegating some of its monetary authority to an independent agency, something Congress does routinely with many government functions. The Federal Reserve is regularly audited. The Government Accountability Office audits its financial operations. Its decisions are reviewed by Congress. It publishes detailed reports on its activities. It's actually one of the more transparent government agencies, though it guards the confidentiality of its internal policy deliberations, just as the Supreme Court doesn't publish drafts of its opinions or recordings of its internal debates. The Federal Reserve is not controlled by the Rothschilds or any other international banking family. This is an anti-Semitic conspiracy theory with no basis in reality. The Rothschild family has no ownership stake in the Federal Reserve, no special influence over its policies, and no connection to its operations beyond being one of thousands of financial institutions around the world that interact with central banks. So the elaborate conspiracy theories, the New World Order stuff, the claims about hidden ownership, the suggestions that the Fed is a foreign-controlled institution are nonsense. They're based on misunderstandings of how the Federal Reserve works, mixed with anti-Semitic stereotypes, seasoned with general suspicion of government and banking. But just because the crazy conspiracy theories are false doesn't mean there aren't legitimate concerns about the Jekyll Island meeting and the creation of the Federal Reserve. Here's what the conspiracy theorists get right, or at least what legitimate critics correctly identify as problematic. First, the Jekyll Island meeting really was secret, and the secrecy really was designed to hide the role of private bankers in designing the system. This isn't conspiracy theory, it's documented fact. The participants used fake names, traveled in secret, and maintained the secrecy for decades. When the truth eventually emerged, it confirmed that banking reform was designed by the very people who would benefit from it, without public knowledge or input. That's troubling from a democratic standpoint. Even if you think the system they designed is good, even if you believe they were genuinely trying to solve a real problem, the process was fundamentally undemocratic. A handful of unelected men met in secret to design a system that would shape the entire economy. No public hearings, no input from people outside the financial industry, no transparency. Second, the Federal Reserve System does benefit large banks more than small banks, and financial institutions more than regular people. This isn't a conspiracy, it's how the system is designed. When there's a financial crisis, the Fed provides liquidity to banks. not directly to individuals or businesses. When the Fed adjusts interest rates, it affects financial markets immediately and the broader economy eventually. Wall Street feels Fed policy changes instantly. Main Street feels them much later and less directly. This creates a structural advantage for large financial institutions. They have closer relationships with the Fed. They understand monetary policy better. They can adjust their strategies fast. They benefit more from the stability the Fed provides. Again, this isn't necessarily nefarious. Large financial institutions play crucial roles in the economy, so stabilizing them can benefit everyone. But it does mean that the Fed's primary relationship is with the banking industry, not with ordinary Americans. That was true from the beginning. The system was designed by bankers for banking stability, and it remains true today. Third, the Federal Reserve does have enormous power with limited democratic accountability. The Fed can create trillions of dollars through monetary policy. It can raise or lower interest rates, affecting whether you can afford a mortgage or a car loan. It can decide which financial institutions to rescue and which to let fail. It influences employment, inflation, and the overall health of the economy. The people making these decisions are not elected. They're appointed to long term specifically to insulate them from political pressure. This independence is designed to prevent short-term political manipulation of monetary policy, stopping politicians from printing money to win elections, for example. But it also means that the Fed operates with less democratic accountability than most government agencies. You can argue this is necessary. Monetary policy requires expertise and long-term thinking that elected politicians may not have. But you can also argue this is dangerous. It gives enormous power to unelected technocrats who may not represent the interests of ordinary people. Fourth, the creation of the Federal Reserve did concentrate financial power. Before the Fed, banking was fragmented and chaotic, but also somewhat decentralized. After the Fed, monetary policy is centralized in Washington and New York. The Federal Reserve Bank of New York quickly became the dominant reserve bank, despite the system's supposedly equal regional structure. Large banks that can navigate the Fed's system have advantages over smaller banks that can't. This concentration was partly intentional. Fragmentation was seen as a problem that needed solving, but it also shifted power away from regional banks and toward the money center banks in New York. Benjamin Strong, running the New York Fed from 1914 to 1928, had more influence over monetary policy than the other 11 regional reserve bank governors combined. So while the conspiracy theories go too far inventing shadowy cabals and nefarious plots, the underlying concerns have merit. The Federal Reserve was created through an undemocratic process. It does favor financial institutions over ordinary people. It does concentrate enormous power in unelected hands, and it was designed by people who had obvious conflicts of interest. These are legitimate issues worth discussing. The problem is that the conspiracy theories make it harder to have that discussion, because any criticism of the Fed gets lumped in with the crazy stuff about Rothschilds and New World Orders. But if we can separate the legitimate concerns from the conspiracy nonsense, we can have a more productive conversation about the Federal Reserve, its creation, and its role in the American economy. So let's look at how the Federal Reserve actually functioned in its early decades, and whether the system designed at Jekyll Island worked as intended. The Federal Reserve in action. First decades. The Federal Reserve System begins operations in November 1914, less than a year after the Federal Reserve Act is signed into law. The timing is significant. World War I has just begun in Europe, and the American economy is about to face unprecedented challenges. The Fed's first major test comes almost immediately. European nations at war need to finance their military operations. They turn to American banks for loans and American businesses for supplies. Gold flows into the United States as European nations pay for American goods. The economy booms, but this also creates potential problems. Traditional monetary theory says that gold inflows should lead to inflation. More money chasing the same amount of goods means higher prices. The Fed faces a choice: allow inflation or try to sterilize the gold inflows by contracting credit elsewhere in the economy. Benjamin Strong, now running the New York Fed, takes an activist approach. He coordinates with the European central banks, particularly the Bank of England, to manage the gold flows and prevent excessive inflation. This isn't what populists who supported the Federal Reserve Act expected. They thought the Fed would be independent of foreign influence, but here's Strong cooperating closely with European bankers. When America enters World War I in 1917, the Fed's role expands dramatically. The government needs to finance the war effort, which means issuing huge amounts of debt, Liberty bonds, and other war bonds. The Fed helps manage this process, keeping interest rates low to make government borrowing affordable. This is the Fed's first experience with what we now call fiscal monetary coordination, using monetary policy to support government fiscal policy. It works well for financing the war, but it also means the Fed subordinates its inflation-fighting mission to the government's borrowing needs. Interest rates are kept artificially low, contributing to inflation during and after the war. The end of the war in 1918 creates new challenges. European economies are devastated. The international gold standard, which had provided monetary stability before the war, is in chaos. Different nations have gone off gold, manipulated their currencies, or accumulated massive debts. The Fed has to navigate this unstable international environment while also managing managing the transition of the American economy from war production to peacetime. Strong handles this reasonably well. He's in constant communication with European central banks. He helps coordinate international monetary policy to the extent possible. He uses the Fed's power to provide stability during the turbulent post-war period. But then comes 121, and the Fed makes its first major mistake. After the wartime inflation, the Fed decides it needs to bring prices back down. In 1920, it raises interest rates sharply and contracts credit. The goal is to squeeze out the inflation and return to stable prices. The policy works, prices do come down, but the contraction is too severe and too sudden. The economy plunges into a sharp recession, and employment spikes. Businesses fail. Farmers, who borrowed heavily during the war boom, are crushed by deflation. The value of their debt stays the same while the prices they receive for crops collapse. The recession is short but brutal. It ends in 1921, and the economy begins recovering. But the episode reveals the difficulty of managing monetary policy. The Fed has enormous power to affect the economy, but using that power effectively requires judgment, timing, and luck. Too much contraction, and you cause recession. Too little, and you get inflation. Finding the right balance is extraordinarily difficult. The 1920s bring a new challenge: the stock market boom. Throughout the decade, stock prices rise dramatically. Speculation increases. People borrow money to buy stocks, assuming prices will keep rising. The Fed watches nervously. Should the Fed intervene? Should it raise interest rates to cool down the speculative fever, or should it let the market run its course? Strong argues against aggressive intervention. He believes the economy is fundamentally sound, that prosperity is real rather than just speculative bubble. He keeps interest rates relatively low, providing the credit that fuels both legitimate economic growth and stock market speculation. Other Fed officials are more concerned. They see the speculation in the stock market and worry that it will end badly. They push for higher interest rates to cool down the market. The debate within the Fed is fierce. It's not clear who's right. Raise rates too soon, and you might choke off real economic growth. Wait too long, and you might let a bubble grow until it bursts catastrophically. Strong dies in 1928, removing the Fed's most experienced and influential leader. His successors are less skilled and less respected. The internal debates continue without Strong's ability to forge consensus. Then comes 1929. The stock market crashes in October. Prices plummet. Fortunes are lost. Banks that lend money for stock speculation face huge losses. This is exactly what the Federal Reserve was created to handle. The system designed at Jekyll Island was supposed to prevent financial panics from spreading, to provide liquidity to troubled banks, to be a lender of last resort that could stabilize the system. But the Fed fails catastrophically. Instead of flooding the system with liquidity, the Fed tightens. Instead of lowering interest rates to stimulate the economy, it keeps rates high. Instead of acting as a lender of last resort, it lets banks fail by the thousands. Why? Partly because the Fed is divided internally. Different reserve banks have different views on what to do. New York wants aggressive action. Other regions are more conservative. Without Strong's leadership, they can't agree on a coordinated response. Partly because the Fed is following outdated economic theory. Many economists in the 1920s believed that depressions were necessary corrections, that speculative excess needed to be purged from the economy through hard times. Let the weak businesses fail, let prices fall, let the market reach a natural bottom. Only then can sustainable recovery begin. We now know this theory is disastrously wrong, but in 1933, it's influential enough that the Fed doesn't act aggressively to prevent the depression, partly because the Fed is constrained by the gold standard. Orthodox monetary theory says that maintaining the gold standard is paramount. You can't just create unlimited amounts of money because each dollar needs to be backed by gold. This limits the Fed's ability to expand credit during a crisis, and partly because the Fed simply doesn't understand how to use its powers effectively. The institution is less than 20 years old. Monetary policy is poorly understood. Economic data is limited. The Fed is operating partly blind, making decisions based on incomplete information and flawed theory. The result is the Great Depression. From 1929 to 1933, the American economy collapses. Employment reaches 25%. Industrial production falls by half. Banks fail by the thousands. Millions lose their savings. The economy contracts by nearly 30%. This is the greatest failure in Federal Reserve history. The institution created to prevent financial panics and stabilize the banking system instead presides over the worst economic catastrophe in American history. Was the Jekyll Island system flawed, or did the Fed simply use its powers incorrectly? Economists still debate this. Some argue that the structure created at Jekyll Island was fundamentally sound, but the Fed made terrible policy decisions. With better leadership, better economic understanding, and more willingness to act aggressively, the Fed could have prevented or at least mitigated the depression. Others argue that the Jekyll Island system had structural flaws. Too much power concentrated in New York. Too much focus on the interests of large banks rather than the broader economy. Too much commitment to the gold standard. The system was designed by bankers for banking stability, and when the broader economy needed help, the Fed protected banks rather than ordinary people. Both perspectives have merit. The Fed certainly made policy mistakes during the Depression, but the structure of the system also mattered. The Fed was more responsive to banking interests than to employment or economic growth, because that's what it was designed to do. Franklin Roosevelt's election in 1932 brings major changes. Roosevelt takes America off the gold standard, removing one constraint on monetary policy. He pushes through banking reforms that strengthen regulation and create deposit insurance. He strips some power from the Federal Reserve Bank of New York and centralizes more authority in the Federal Reserve Board in Washington. These reforms address some of the problems revealed by the Depression. They make the Fed more accountable to government, less focused solely on banking interests, more able to respond to economic downturns. But they also move the Federal Reserve further from the Jekyll Island vision. The system becomes more government-controlled, less banker-controlled, more focused on employment and economic growth, less focused solely on price stability and banking soundness. Is this good or bad? Depends on your perspective. If you think the Jekyll Island design was flawed, these reforms correct its mistakes. If you think the original design was sound, these reforms corrupt it by introducing political considerations into what should be technical monetary policy. Either way, the Federal Reserve that emerges from the Depression is significantly different from the one created in 1913, and both are different from what was designed at Jekyll Island in 1910. So let's fast forward to the present and see how the Jekyll Island legacy plays out in the modern Federal Reserve. Modern Federal Reserve and Jekyll Island's legacy. Today, the Federal Reserve is one of the most powerful institutions in the world. It controls trillions of dollars through monetary policy. Its decisions affect not just the American economy, but the global economy. Its chairman is often called the second most powerful person in America. How did we get from 7 men meeting in secret on a Georgia island to this massive institution? The modern Federal Reserve has evolved far beyond the Jekyll Island blueprint. The structure is recognizable 12 regional reserve banks coordinated by a board in Washington. But the function has expanded dramatically. The original Federal Reserve focused primarily on banking stability, preventing panics, providing liquidity, facilitating check clearing. The modern Fed has a much broader mandate: maximum employment, stable prices, moderate long-term interest rates. It's responsible not just for banking stability, but for managing the entire economy. This expansion happened gradually. The Employment Act of 1946 made the federal government responsible for maintaining full employment. The Federal Reserve was implicitly included in this mission. By the 1970s, the Fed explicitly recognized a dual mandate: price stability and maximum employment. This is very different from the Jekyll Island vision. Warburg and the others were designing a system to stabilize banking, not to manage employment levels. But over time, the Fed's role expanded as Americans came to expect government to actively manage the economy rather than just provide a stable monetary framework. Federal Reserve's power also grew enormously. In the Jekyll Island design, the Fed could create currency, provide emergency loans to banks, and facilitate check clearing. Important functions, but relatively limited. The modern Fed can do all that plus set interest rates that affect every loan in America, buy and sell trillions of dollars in government securities, regulate major financial institutions, intervene in foreign exchange markets, create entirely new programs during crises, and essentially create unlimited amounts of money through quantitative easing. Some of these powers were used during the 2008 financial crisis, and they would have shocked the Jekyll Island participants. When Lehman Brothers failed in September 2008, the Fed created trillions of dollars in new lending programs, bought mortgage-backed securities, coordinated with foreign central banks, and prevented what could have been another Great Depression. The response was effective in preventing total collapse, but it also revealed how much power the Fed has accumulated over a century. The Fed essentially rescued the financial system, bailed out major institutions, and reshaped the economy, all without congressional approval, all based on authority the Fed claimed it had under various statutes. This raises the same democratic accountability questions that surround the Jekyll Island meeting. Should unelected officials have this much power? Should they be able to create trillions of dollars and reshape the economy without democratic input? Defenders argue that crises require fast action by experts, not slow democratic deliberation. If the Fed had waited for Congress to debate what to do in 2008, the financial system would have collapsed before any decision was reached. Critics counter that this proves how dangerous it is to concentrate so much power in unelected hands. The Fed's 2008 interventions benefited Wall Street banks much more than ordinary Americans. The bankers whose reckless decisions caused the crisis were bailed out, while homeowners who couldn't pay their mortgages lost their houses. Sound familiar? It's essentially the same debate that surrounded the Jekyll Island meeting. Expertise versus democracy. Efficiency versus accountability. Technocratic competence versus democratic legitimacy. The 2008 crisis also revealed how the Fed remains closely connected to the financial industry. It regulates, just as it was at Jekyll Island. When the Fed needed to understand what was happening in financial markets, it turned to the major banks. When it needed to implement policy, it worked through the major banks. When it needed to decide which institutions were too important to fail, it took seriously the warnings from those same institutions about the consequences of letting them collapse. This isn't corruption in the simple sense. The Fed officials weren't taking bribes or deliberately favoring their friends. The structural bias is real. The Fed's closest relationships are with large financial institutions. Its former officials often work for those institutions. Its current officials often come from those institutions. This creates a worldview where the health of major banks is equated with the health of the economy, which may not always be true. Again, this connects directly to Jekyll Island. The system was designed by bankers for banking stability. A century later, that origin institution still shapes how the Fed operates and whose interests it prioritizes. But the modern Fed has also evolved in ways that address some of the Jekyll Island concerns. It's more transparent than it used to be, publishing detailed minutes of its meetings, explaining its decisions in press conferences, admitting to congressional oversight. It's more accountable to government. The board is entirely composed of presidential appointees confirmed by the Senate, and Congress can change the Fed's powers through legislation, and it's more focused on the broader economy rather than just banking. The dual mandate of maximum employment and price stability means the Fed has to care about jobs and inflation, not just bank soundness. So is the modern Federal Reserve the institution designed at Jekyll Island? In some ways yes, in some ways no. The basic structure, regional reserve banks coordinated by a central board, remains. The hybrid public-private character persists, though the balance has shifted toward public control. The core functions of providing liquidity, creating elastic currency, and stabilizing banking continue, but the scope of power, the breadth of mandate, and the accumulated responsibilities go far beyond anything the Jekyll Island participants imagined. They were designing an institution to prevent bank panics. We've ended up with an institution that manages the entire economy and influences the global financial system. Whether that's good or bad depends on your perspective. Maybe it's an impressive evolution, a system that's adapted to meet the economy's changing needs. Or maybe it's mission creep, an unaccountable bureaucracy that's accumulated far too much power. Before we try to answer that, let's take stock of what the Federal Reserve has gotten right, and what it's gotten wrong over its century plus of operation. What they got right, what they got wrong. Let's start with what the Jekyll Island system got right, what's worked well over the Federal Reserve's history. First, the basic structure. The regional reserve bank system, coordinated by a central board in Washington, has proven reasonably effective. It balances centralized policy making with regional representation, combines private sector expertise with government oversight. It's more flexible than a purely government bureaucracy, but more accountable than a purely private institution. Is it perfect? No. The Federal Reserve Bank of New York dominates the system despite the supposedly equal regional structure. The other 11 reserve banks have much less influence, but overall, the hybrid structure has worked better than many predicted. Second, the elimination of bank panics.